Hey guys, Dave Keller here with Market Misbehavior, coming to you on location from Boston, Massachusetts today. Today we're going to talk about the anatomy of a market top with one particular example, Dominos Pizza Group. While it's an interesting stock that's gapped lower this week, it's also a perfect example of a distribution phase. Now a stock is rotated from going up to going down. We'll look at the characteristics of that top, what that might imply for the S&P 500 going forward. Before we get to the charts, here's one more thing I want to tell you about. I'm a technical analyst, which means I spend hours every day looking at hundreds, if not thousands of charts. But in my own decision-making process, it's not purely technical. I actually spend a decent amount of time looking at fundamental factors that are actually driving companies and empowering them to grow for multiple years going forward. I look at macroeconomic data like the Fed and inflation and interest rates to think about how all those factors might impact those stocks and ETFs that I'm looking at. And I also have learned from spending years working with institutional investors that having a good quantitative model is super important. What a quantitative model does is basically look at the characteristics of successful stocks, looks at all the factors, technical, fundamental, everything, and wraps it into one rating, and then allows you to focus on the best opportunities within a particular set of stocks or ETFs. The good news is, as an individual investor in 2024, you have access to a pretty decent quantitative model through Seeking Alpha. If you go to marketmisbehavior.com/seeking-alpha, you'll be able to take advantage of their quantitative rating. They actually have a pretty sophisticated quant model that is driving their quant rating. You can then cross-reference what we're talking about on this video, is looking at the charts of leading stocks, looking for big base breakouts and good technical opportunities, but also look to see if the quantitative model from Seeking Alpha supports the upside potential of those names. So go to marketmisbehavior.com/seeking-alpha to find more information. Usually get a better deal for you. It's an affiliate link, which means it helps me make Market Misbehavior awesome, and we're all happy. So check it out, and let's get back to the charts here. So the example we're going to use today is Dominos Pizza Group, ticker DPZ. Now, Domino's Pizza has actually been in a bit of a downtrend here for the last month or so. It initially made a peak in April, toward the end of April, with this gap higher, which you'd probably call an exhaustion gap. That's a gap that happens after a significant run, after a big uptrend. That last gasp, think of it as that last gasp of exhaustion as you finally, after running all the way up the hill, you're finally bent over as you make it to the top. That is what an exhaustion gap looks and feels like. From there, we retested that peak in June, and then never really broke down until the end of June, beginning of July. Look at how June is really a stock in a consolidation phase. July, all of a sudden, is a stock in a distribution phase. So the stock gapped lower this week. It was down about 13.5% on Thursday's session, gapping below the 200-day moving average. What's interesting, though, is I would argue that the signs of distribution have been building for weeks and weeks now. So if you were surprised by the downward gap in Domino's Pizza on Thursday, I think that means more that you were ignoring some of the clear signs of distribution that were very obvious well before Thursday's gap lower. So let's talk about sort of the anatomy of a market top and what sort of technical approaches can help us identify stocks that are no longer in an accumulation phase and really beginning a distribution phase. Well, first off, we need to define what an accumulation phase looks like. For me, I think of the market in three phases at any point, right? An accumulation phase is a pattern of higher highs and higher lows where buying power is overwhelming selling pressure. You have a distribution phase of lower lows and lower highs when selling pressure is overwhelming any interest in buying. Then you have a consolidation phase, which is kind of that third sideways movement where market's in equilibrium and buyers and sellers are sort of in concert together. An accumulation phase is a pattern of higher highs and higher lows. Ideally, we're above two upward sloping moving averages. The RSI, the momentum, is strong but not excessive. And on pullbacks, the RSI remains above 40. Those characteristics that I just mentioned, higher highs and higher lows in price, the price above two upward sloping moving averages, the momentum strong, meaning, ideally above 50 fairly consistently, but on pullbacks remains above 40. That is the sign of a stock in an accumulation phase. So what marks a rotation from an accumulation phase to a distribution phase? Well, it's pretty much all of those things, those factors that I just mentioned, no longer are the case. So let's look at what happened on the chart of DPZ, and you can see how that accumulation phase clearly ended, and we began a distribution phase again before the big gap lower this week. First off, and I think what's most telling, is we failed to make a new high. An uptrend, an accumulation phase, is a consistent pattern of higher highs and higher lows, meaning when we go to make a new high, investors are pushing prices above the previous peak, meaning buyers are more optimistic than they were before. At least they're expressing that optimism in the form of accumulating shares. On pullbacks, we tend to make higher lows because that means as the price pulls back, additional buyers are coming in and excited to ride the wave higher. So an accumulation phase ends when there's no longer that optimism, when people are no longer pushing prices to new highs. There's not enough buying power to eclipse the previous peak, and that's exactly what we saw in mid-June, right? You have the peak here in late April around 540. Here in mid-June, we've topped out almost exactly the same level. So that is a clear red flag for me that all of a sudden that optimism that has been fueling the first 6 months of 2024 starting to dissipate more, right? We're sort of at an exhaustion point where there's no longer that buying power that there used to be, or at least all the buyers have already bought, anecdotally speaking. Now, the other part of that is you stop making higher lows, right? You make lower lows. And so I would say right around here, when Domino's Pizza breaks below its previous swing low around 500, that was the support in late May. The fact that we didn't hold that level, that we popped up and retested that level from below and then rotated lower, those are all signs of a stock, no longer holding support, meaning that pattern of investors buying on the dips is no longer happening. Those dip buyers are gone, or they've already bought, and no one's left to sort of propel that next leg higher. So an inability to make a new high and then a new swing low really is one of those often great signals of a rotation to a distribution phase. Let's talk about the moving averages here, because in an uptrend phase in the first half of 2024, Domino's Pizza is trading above two upward sloping moving averages. Prices above the 50-day, 50-day is above the 200-day, the 50 and 200-day moving averages are both sloping higher. That's a great pattern to see in a stock that you own, because that just means long and strong, slow and steady, the things just keeps going up. And you look for a sign that that's changing. So note that when DPZ broke below its May low, that also pushed the stock below its 50-day moving average. As of the end of this week, the 50-day moving average is now sloping downwards. So we're no longer above two upward sloping 200-day and 50-day moving averages. We're actually below a downward sloping 50-day moving average. So that tells you, again, something has changed, what we call a change of character on the chart. So the shape of the moving averages, the relationship of price to the moving averages, tells us a lot about what phase we might be in, and the fact that we were unable to hold an ascending 50-day moving average is often a good red flag as well. Now let's look at the bottom panel. Remember what we talked about, momentum in an accumulation phase, higher highs, higher lows, and you look for that pattern to continue. And you look for the momentum to remain fairly consistently strong. Look at how that now has changed, right? In the month of June, May, April, March, February, January, we have the RSI pretty consistently above 40 and never really breaking below 40. So those pullbacks were met by fairly decent momentum. But look at how that changed here in early July, where we see the RSI break below 40 on this pullback. So all around the same time as the stock is breaking below an ascending 50-day moving average, as the price is failing to hold its previous swing low, as we're not making a new high, as the moving averages are turning downwards, the momentum is also telling you that this is a weaker pattern. Now, what is RSI really measuring? What you have to remember is the RSI indicator, relative strength index, is actually looking at a period of time, and it's looking at the average up day and the average down day. In an uptrend, the average up days tend to be much stronger than the down days, because in any move, you're gonna have up and down days, right? Noise of the market. But in an uptrend, the up days tend to be a lot stronger than the down days. In a downtrend, the down days tend to be a lot stronger than the up days. So when the RSI goes from above 50 to below 50, that tells you, generally speaking, that the down days are becoming a lot stronger, meaning there's distribution happening. There are investors selling off on the previous strength, taking profits, unwinding positions, and that tends to lead to further deterioration. As they say, selling tends to beget further selling. Now, all of those factors, the Dow theory, the moving averages, the momentum, tend to be reflected in relative performance as well. So here's the performance of DPZ versus the S&P 500. Note how from late April to really mid-July, the trend in the relative performance has been down, meaning DPZ has been underperforming the S&P 500 during the stretch, because that's because the S&P and the NASDAQ have been doing just fine overall, continuing their uptrend. That means a stock sort of in a sideways phase, and then certainly in the distribution phase, is going to be underperforming the benchmarks, and that's pretty much what we've seen. So those are the signs of a clear top on a chart. The Dow theory is no longer an accumulation phase, starts to show distribution. We failed to hold recent swing lows. We are going from above upward sloping moving averages to below those moving averages. The momentum clearly shifts from a bullish range to a bearish range, and the relative strength starts to deteriorate. Now, why are we talking about the chart of DPZ today? Here's my concern. The chart of the S&P 500 looks a lot like DPZ, sort of at the end of that upward phase. Now, we haven't had that exhaustion gap that we saw in DPZ, and we haven't broken down yet in all the ways that we've seen. However, if you look at the conditions on the chart of DPZ, think about all those things that we saw. That would be the checklist I would have in my mind as I'm looking at the chart of the S&P or the QQQ or whatever major benchmark I'm looking at today, because those patterns tend to be pretty consistent at market top. So in the chart of the S&P, do we fail to make a new high? Do we start to break below the recent swing low? Do we break below an upward sloping 50-day moving average? Does the momentum deteriorate and the RSI break below 40? Those could be the signs of a major market top as we enter some of the seasonally weaker parts of the year, like August and September. For Market Misbehavior, I'm Dave Keller. Be well, stay safe, have a great one.